And if you're wondering whether this is just noise or the start of something much bigger, you're asking the right question. Because here's the thing, this move didn't come out of nowhere. There are two numbers on the macro dashboard that are flashing right now, and most people aren't connecting the dots. In this video, I'm going to break down exactly what's driving silver, show you the three scenarios I'm watching for what happens next, and give you a simple checklist, whether you're holding for the long term or actively trading this thing. In this video, I'm going to break down exactly what's driving silver, show you the three scenarios I'm watching for what happens next, and give you a simple checklist, whether you're holding for the long term or actively trading this thing. Stay with me, this one matters. What's going on, everyone? So, February 9th, 2026. Let's talk about what just happened, and more importantly, what it means going forward. Silver is reacting to the macro dashboard. That's the frame for today. And when I say macro dashboard, I'm talking specifically about two instruments, the dollar index, the DXY, and the 10-year Treasury yield. These two things together, they're essentially the cockpit instruments for precious metals. And right now, both of them are telling the same story. In a second, I'm going to show you exactly how these two forces are aligning, and why silver in particular is responding more aggressively than gold. But first, let me give you the quick recap of what happened this week, because context matters. All right, here's the snapshot. CME Silver Futures, the March contract SIH6, closed at 81.13 as of Saturday night, February 8th. That's up $4.23 on the session, a 5.51% move. Source is CME Group directly. Now, a 5.5% move in silver is not nothing. This isn't some penny stock. This is one of the largest commodity markets in the world. When silver moves like this in a day, the macro is speaking. So what changed? Let's look at the dashboard. First, the dollar index. According to MarketWatch, DXY is sitting around 97.59. Now, for those of you who've been watching the dollar over the past few years, you know that 97 is significant. We spent a lot of time above 100, above 105 even. The dollar was a wrecking ball for commodities. But now, we're sub 98, and more importantly, the trajectory is down. Second, the 10-year Treasury yield. Fed's latest data point, February 5th, shows the 10-year at 4.21%. Now, 4.21 is still historically elevated, but here's the key. It's not rising anymore. And in markets, direction matters as much as level. So you've got a weakening dollar and stabilizing to falling yields. That's the setup. And silver? Silver is responding exactly how you'd expect a monetary metal to respond in that environment. But wait, I said silver is more than just a monetary metal. And that's where it gets interesting. I'll come back to that in a minute because it's crucial to understanding why silver might have more room to run here than people think. Okay, let's make this simple. Because I know some of you are busy and you don't need a PhD in macroeconomics. You just need to understand the mechanics. Think of the dollar and silver like two kids on a seesaw. When the dollar is heavy, strong, high, it pushes silver down. When the dollar gets lighter, weakens, falls, silver goes up. Why? Because silver is priced in dollars globally. When the dollar weakens, it takes fewer foreign currency units to buy the same ounce of silver. Demand increases, price rises. Simple as that. Now yields are a bit different. Let me explain. Treasury yields represent the risk-free return you can get by lending money to the US government. When that return is high, like say 5%, investors think, why would I hold silver, which pays me nothing, when I can earn 5% risk-free? Silver has no yield. It just sits there, being shiny. So high yields make silver less attractive. They raise the opportunity cost of holding it. But when yields fall, that opportunity cost drops. Suddenly, silver looks a lot more appealing. And right now, yields are coming down from their highs. The 10-year at 4.21%, down from peaks we saw in previous months, is signaling that the bond market sees slower growth, maybe even rate cuts ahead. When both of these things happen together, that's when you get moves like we saw this week. That's when silver rips 5.5% in a session. But here's where silver gets really interesting. And this is the part most gold bugs overlook. Silver isn't just money. It's also an industrial metal. About 50% of silver demand comes from industrial uses: solar panels, electronics, EVs, medical devices. This is real physical demand that has nothing to do with whether you think the Fed is going to cut rates. So silver has this dual personality. When macro conditions favor precious metals, weak dollar, low yields, silver benefits as a monetary asset. But it also benefits from industrial demand, which tends to rise when the economy is doing okay and infrastructure spending is happening. This is why silver can outperform gold in certain environments. It's catching tailwinds from both directions. And right now, we might be in one of those environments. Question for you in the comments. Do you think silver's industrial demand is underappreciated, or do you think the monetary side is what really drives the price? Drop your take below. I read every comment. All right, let's talk about what the big money is doing. Because price is one thing, but positioning tells you who's behind the move. The CFTC, that's the Commodity Futures Trading Commission, releases a report every week called The Commitment of Traders. It shows us how different groups are positioned in the futures market. Now, this data is as of February 3rd, so it's a few days old, updated on February 6th. Keep that in mind. COT data is context, not timing. It tells you who's leaning which way, not when the next move happens. Here's what we've got. Open interest in COMEX silver futures, 180 contracts. Non-commercial traders. These are the speculators, the hedge funds, the managed money. Long 38,983 contracts. Short 13,006 contracts. Spreads 36,580 contracts. So net long about 25,800 contracts. That's a meaningful bullish lean. Commercial traders, these are the producers, the refiners, the industrial users, the dealers. Long 35,248 contracts. Short 80,973 contracts. Net short about 45,700 contracts. Now here's where it gets interesting. And this is what I wanted to come back to. Some people see that commercial short position and panic. Oh no, the smart money is short. But that's not how you read this. Commercials are always net short in silver. They're hedging production. They're locking in prices. That's their business. A large commercial short position in a rising market often just means producers are hedging more aggressively because prices are high. What matters more is the trend in positioning. Are specs adding to longs? Are commercials covering shorts? That's what you want to watch over the coming weeks. I'm going to do a deeper COT analysis in an upcoming video. Really break down what these numbers mean cycle by cycle. So if you want that, make sure you're subscribed. Now let's check in on the physical side, because futures are one thing, but real metal is what matters in the end. I like to use PSLV, the Sprott Physical Silver Trust, as a proxy for physical demand. Unlike some other ETFs, Sprott actually holds allocated silver. You can see how much. As of February 6th, according to Sprott's website, PSLV held just under 217 million ounces of silver. 216,931,156 ounces to be exact. Now what I'm watching here is the trend. Are ounces being added or redeemed? Is physical demand matching the futures enthusiasm? Because here's the thing, futures can run hot on pure speculation. But when you see physical accumulation keeping pace, that's confirmation. That's real buyers taking metal off the market. I'll keep updating this number in future videos. If you see PSLV adding ounces while price rises, that's bullish confirmation. If you see ounces being drained while price rises, that's a divergence you want to be careful of. Okay, this is the part everyone's been waiting for. What happens next? I'm going to give you 3 scenarios, bull, base, and bear, and tie each one to specific triggers. That way you're not guessing. You're watching the data and letting it tell you which path we're on. Scenario 1, the bull case. In the bull case, here's what happens. DXY continues to break down, falling below 97 and potentially toward 95 or lower. 10-year yields keep drifting down, maybe toward 4% or below, as the market prices in slower growth or rate cuts. Speculative positioning in COT continues to build long. Physical demand stays strong. PSLV adds ounces. If all of that happens, silver has room to run higher. We're already at $81, but in a true macro pivot environment, the upside could surprise people. Trigger to watch, DXY breaking below 97 with conviction. That would be the confirmation that the dollar downtrend is accelerating. Scenario 2, the base case. The base case is consolidation. DXY stabilizes in the 97-100 range. No breakdown, but no strong rebound either. 10-year yields hover around 4.1–4.3%. Markets wait for more data. Silver chops sideways, digesting this recent move. Volatility stays elevated, but no clear trend. This is the wait-and-see scenario. It's not bearish, but it's not a breakout either. Traders get chopped up, holders get impatient. Trigger to watch. If DXY reclaims 100 but can't push higher and yields stay pinned, we're probably in this range. Scenario 3, the bear case. Here's what would make me cautious. DXY rebounds sharply, back above 100, maybe toward 103. 10-year yields spike. back above 4.5% on hot inflation data, or Fed hawkishness. Speculative longs in COT get crowded and start unwinding. Physical demand softens. PSLV sees redemptions. If that happens, this silver rally fades. You'd probably see a pullback to digest the recent gains. Trigger to watch. DXY reclaiming 100 with momentum. That would be the signal that the dollar is reasserting strength. So there's your roadmap. 3 paths, 3 sets of triggers. Your job is to watch the dashboard and let the data tell you which scenario is playing out. Second question for you. Which scenario do you think is most likely? Bull, base, or bear? Comment below. I want to see where the community stands. All right, let's talk levels. This is for the traders in the room. Now, I'm going to keep this simple because I don't want to invent specific support and resistance numbers that aren't in the data. But I can give you a framework. Silver futures at 81.13 as of the last update. That's your anchor. What to watch? Round numbers matter psychologically. $80 is obvious support. $85 would be the next psychological magnet if we break higher. The weekly close matters. Where silver closes on Friday is more important than intraday noise. Weekly closes above $80 confirm the strength. Volatility is elevated. CME's margins page, which I'll link in the description, shows you margin requirements for silver futures. When margins are high, volatility is high. That means position sizing matters more than ever. Invalidation logic. If you're long silver and DXY starts reclaiming 100, that's your warning. If 10-year yield starts spiking back toward 4.5%, that's your second warning. Don't fight the macro. If the dashboard flips, respect it. For holders, you're not trading every tick. Your job is to watch the bigger picture. As long as DXY stays weak and yields stay contained, the trend is your friend. For traders, tighter stops, smaller size, because volatility cuts both ways at these prices. Here's my personal checklist for the week ahead. I'm giving you this so you can track the same things I'm tracking. Number 1, DXY. Does it hold below 98 or reclaim 100? This is the most important single variable. Dollar weakness is fueling this rally. If DXY stabilizes and rebounds, the rally pauses. Number 2, 10-year yield. Does it drift toward 4% or spike back up? Next Fed update will tell us. Watch for any data surprises that might move yields. Number 3, economic calendar. What's on deck? MarketWatch's economic calendar, linked in the description, shows upcoming reports and Fed speakers. Any surprise inflation data or hawkish Fed commentary could jolt yields higher. Number 4, COT update. How is positioning shifting? Friday's COT release will be crucial. Are specs still adding longs? Are commercials adjusting their hedges? Number 5, PSLV holdings. Is physical demand confirming? If ounces are being added, that's bullish. If ounces are being drained, that's a yellow flag. 5 items. That's it. Check these every day, and you'll know more than 90% of people talking about silver on the internet. Comment checklist below if you want me to keep doing these rundowns. It helps me know what's useful. All right, now the important part, risk. I know we just spent 20 minutes talking about why silver is moving and what could happen next. But let me be crystal clear about a few things. Volatility is real at these levels. Silver at $81 is not silver at 25. The dollar moves are bigger. The percentage swings are bigger. If you're not comfortable with that volatility, size down. Seriously. There's no shame in trading smaller when the range gets wild. COT data is weekly, not real time. The positioning data I showed you is from February 3rd. Things can change fast. Don't treat COT as a timing tool. Treat it as context. It tells you who's leaning which way, not when the next candle will print. Margin requirements can change. CME adjusts margins based on volatility. If silver keeps ripping, they might raise margins. That can force liquidations. Be aware of it if you're trading futures. Macro can flip fast. A surprise Fed statement, a hot CPI print, a geopolitical shock. Any of these can reverse the DXY and yield trends overnight. Have a plan. Know your exit before you need it. And finally, I'm not your financial advisor. This is education and analysis, not personalized advice. I don't know your situation, your risk tolerance, or your goals. Everything in this video is for informational purposes. Do your own research. Talk to a professional if you need to. All right, let's bring it home. Here's what we covered. Silver ripped over 5.5% to $81.13, the biggest move in a while. The move is being driven by the macro dashboard. DXY weakening to 97.59, 10-year yields pulling back to 4.21%. Silver's dual nature, monetary and industrial, gives it unique tailwinds in this environment. Positioning from the CFTC shows specs leaning long, commercials hedging as usual. Physical demand via PSLV is holding strong at 217 million ounces. 3 scenarios. Bull if DXY breaks below 97, base if we chop in a range, bear if DXY reclaims 100. The checklist: DXY, yields, calendar, COT, PSLV. Watch all 5. That's the playbook. If this was helpful, do me a favor. Hit the like button. It helps the algorithm show this to more people who care about this stuff. And subscribe if you want more of these breakdowns. I'm doing these regularly now. Next week, I'm going deeper. I'm going to do either a COMEX inventory and delivery analysis, because that physical metal flow story is heating up, or a full COT deep dive where I walk you through how to read the data yourself. Let me know in the comments which one you want first, COMEX or COT. I'll see you in the next one. Stay sharp.